Here's a question that might keep you up at night. What happens to your business and your wealth when you're no longer here to protect it? Most successful business owners spend decades building their wealth, but never spend a single afternoon properly planning what happens to it when they die. And that's exactly how a $15 million business owner I know ended up costing his family $8 million in taxes and legal fees. His family had to sell the business just to pay the government. My name is Samuel Harnish, and I'm the founder of Quantitative Financial Strategies. And unfortunately, I see stories like this all the time. The most successful people in the world can build incredible wealth, but when it comes to estate planning, they sometimes make mistakes that would make a first-year law student cringe. In this video, I'm going to show you some of the worst estate planning mistakes that could potentially cost your family millions of dollars. And more importantly, I'll explain how to make sure you're not making them. Because if you've worked this hard to build wealth, the last thing you want is for the government and lawyers to be your biggest beneficiaries. And I totally get this because when you're busy building wealth, you feel like estate planning is something you can put off until later. But let me show you why that thinking can be a big problem. So the first problem is simply having no estate plan at all. If you die without a will or trust, the state steps in and it won't settle things the way you would have wanted. Without an estate plan, your assets go through probate court, and that means a judge, not your family, decides who gets what, and it can take 12 to 24 months or even more. And if you're a business owner, the court might appoint someone to run your business even if they have no experience. Probate can also force your company into liquidation, even if it's a successful business, just so the assets can get distributed. And that's how generational wealth can get destroyed. So let's look at some numbers. If you died with a $10 million estate and no trust, probate fees alone could eat up to 3 to 5% or $300,000 to $500,000 just in court and attorney fees. And that's before taxes, family disputes, or delays. But with a proper plan in place, you might be able to avoid all of that. Mistake number 2 is outdated beneficiary designations. This is one of the worst mistakes, and it's also the easiest one to fix. So let's say you've got a will that spells out exactly who gets what, but your old 401k from 3 jobs ago, if it has someone listed as the beneficiary, that overrides whatever is in your will. So what's brutal and happens all the time is that someone has a former spouse, someone that they have divorced, that they made as the beneficiary on one of their retirement accounts, and they don't remember to change it. And if you were to pass away, the assets in the retirement account are going to go to that ex-spouse, not your kids or whoever you want it to go to, whoever you spelled it out in your will that you wanted those assets to go to. It doesn't matter. The beneficiary designation on that retirement account overrides whatever's in the will. And this doesn't just apply to retirement accounts. It also applies to life insurance, annuities, and some brokerage accounts. So make sure you double check those retirement accounts and that you have the correct beneficiaries listed that you actually want the assets to go to. All right, next we'll talk about you business owners. Often your business is your largest asset, so it's critical that you plan ahead of time what's going to happen to it. When you die, the IRS assigns a value to your business, and it's not based on what someone will actually pay for it, it's based on what they think it's worth. And your estate is expected to pay taxes on that number. And now the nightmare scenario, and it happens all the time, let's say your business is valued at $10 million by the IRS when you suddenly pass away. Your family owes $4 million in estate taxes and they don't have the cash. So the only option is a rushed sale at a discount, sometimes as big as 50%. So say you only got $5 million for that business, you paid off the $4 million in estate taxes, and all you're left with for your $10 million business is $1 million. So to avoid all of that, a proper business succession plan has 3 things. 1, it establishes a fair valuation formula. 2, outlines a funding mechanism, and most of the time people are using life insurance for this. And 3, it clarifies the roles, rights, and responsibilities of all the involved parties. Now, before I show you the next mistakes, I want to be very clear about something. As you can see, proper estate planning for business owners isn't just about having a will. It requires sophisticated strategies, the right legal structure, and coordination between your estate attorney, tax advisor, and investment management. At QFS, we work with families who have $5 million or more in investable assets, and estate planning coordination is a core part of what we do. Obviously, we can't work with everyone, and these strategies require significant assets and the right circumstances to implement properly. If you're in that category and you want to see how we could work together to protect your family's wealth, definitely reach out after this video. But let me show you the next mistake, and it's one that I see a lot of people get wrong, and that's not understanding estate tax exemptions. So the One Big Beautiful Bill just upped the federal estate tax exemption to $15 million for individuals and $30 million for married couples. And this provides tons of estate planning opportunities if you're proactive. And to be clear, I'm only talking about federal estate taxes right now. States like New York, Massachusetts, Oregon, and Washington can tax estates with as little as $1 million. But for now, we're just going to focus on the federal side. So here's the good news. You can lock in these higher exemption amounts today, even if they drop in the future. Strategies like spousal lifetime access trusts, or SLATs, grantor retained annuity trusts, or GRATs, dynasty trusts, and gifting discounted interests in private businesses or real estate can all help you take advantage of the large exemptions now before they're gone. And if you're building multi-generational wealth, there's a sneaky tax that a lot of people miss. It's called the generation skipping transfer tax, or GST. And if you ignore it, it can cost your family millions. The GST tax is a separate 40% tax that the IRS imposes when you leave money to someone 2 or more generations below you, like your grandchildren. Even if you've already paid estate or gift taxes, the GST tax is stacked on top. This means your money can be taxed twice if you don't plan ahead. Say you want to skip your kids and leave money directly to your grandchildren. Or maybe your kids are successful and they don't need the money, but you want to fund education or housing for your grandkids. If you don't use your GST exemption, those gifts could face an extra 40% tax on top of any estate or gift tax you already paid. And unlike other exemptions, you must actively allocate your GST exemption. It doesn't just apply automatically. So this is where that dynasty trust comes in. When it's structured correctly, a dynasty trust can avoid estate taxes for generations, avoid GST taxes entirely, protect assets from lawsuits, creditors, and divorces, and keep wealth growing inside a protected structure for 100 plus years. Many states have even repealed their rules against perpetuities, which means your trust can last forever. The laws have never been more favorable for these trusts than they are today, so it's a great time to take advantage of them. Last thing I want to touch on is integrating your investment strategy with your estate plan. Most people treat estate planning and investing as two separate conversations, but the most successful families know that the two have to work together. And if you don't, you're going to leave millions of dollars on the table. Depending on the trust that you set up, some of the tax characteristics of the investments you're doing in the trust can still flow through to you. For example, a lot of times I see people happy about their intentionally defective grantor trust where they're paying taxes on the income that the trust is generating, thinking that that's a good thing because they're reducing their estate by paying taxes on behalf of the trust. And while that sounds good from an estate planning perspective, if we just look at it thinking more about the investments, if the tax characteristics are going to flow through to you, why wouldn't you invest that trust in a way that creates paper losses and deductions that you could then pull through to your own tax return and reduce your income taxes and capital gains taxes? It's just a naive assumption that I've seen people make that it's optimal to be paying taxes on behalf of your trusts, and then there's no regard for the way that the trust is being invested. And what you're really doing is you're just reducing your overall net worth because you're creating unnecessary taxes. And lastly, we can't talk about estate planning without mentioning the use of life insurance. One of the easiest no-brainer estate planning strategies is to put a life insurance policy inside an irrevocable life insurance trust, or an ILIT. And what that does is that removes the assets from your estate as you're paying the premiums. And then when you pass and there's this large payout, it's occurring outside of your estate because it's sitting in an irrevocable trust. And this is critical for big estates because what it does is it creates liquidity for your heirs to pay any taxes that come up, or also to buy the business interests. Now, if it's poorly structured, it can create more problems than it solves. But done right, it's just a liquidity engine for your legacy. Coordinating your estate plan with your investment strategy is how you're going to maximize the amount of assets you're able to actually pass on and keep your legacy intact. The reality is, estate planning for successful business owners is incredibly complex and the stakes can be enormous. I've seen families lose more in estate taxes and legal fees than they made in their entire career simply because they waited too long or worked with advisors that didn't understand the sophisticated strategies that are available. And here's what makes it worse. Most of these mistakes are irreversible once they happen. You can't fix estate planning problems when you're gone. If you're a business owner with significant wealth and you don't have a comprehensive estate plan that's been updated in the past few years, then you're playing with fire. That's why I'd encourage you to click a link in the description and book a consultation call with us. We can review your current situation and figure out what gaps currently exist in your estate plan. We'll talk about your specific circumstances, your business structure, and your family's goals, and I can walk you through exactly how we might be able to help protect what you've built. But even if you're not ready to work with us yet, please don't wait on this. Estate Estate planning is one of those things where procrastination literally costs millions. Make sure to subscribe to the channel for more videos on protecting and growing wealth, and I'll see you in the next video.